Hey there, everybody. Good morning, good afternoon, good evening, depending on where you guys are at. I hope you're all having a wonderful Wednesday. Let's get started with SPX here. Then we'll go over the Fed minutes that will be released later today, what we might anticipate going into it. And then we will certainly go from there. So let me just do one thing here. There we go. Hey there, Kona, Mirza, Lorna, CJ. Asian, is it bad? Okay, I don't know why it keeps doing that. Give me 1 second then and let me try and fix the audio. Fine? Okay. Is it just for some people that it's bad? Is fine too? Nanda, you might need to reset if it's just on your end. Sounds good coming through on my headphones, but hey, Rush, good to see ya over on Twitch. And it sounds good there too, Dakudo. Thanks. I appreciate that. So let's get started then with SPX. If it does get really bad for all of you guys, let me know and I'll reset things. But otherwise, we'll get going from here. So starting with today, we basically, right, this is a level that we've talked about both here on Twitch and YouTube, as well as in the free room, really in all my room sessions that I've done over at Simpler, how 4,200 has been a big line of resistance. Let's actually bring up the weekly chart just so you guys can see that visual aspect of where that 100 period simple is. It has basically been the top end of our range all year. We have struggled to break above this level as we have been trading. And so here's the 100 period simple right here, this solid gold line. We also have a gap fill at 42.18 and like 70 cents. That is still looking to get filled. It has not been filled yet. And then right above that is the ATR trailing stop at 42.60. So quite a few different levels of resistance here that we've struggled to get past. We've talked about every time how we've gotten close to this level, the clue that we might not be able to break it, other than, of course, the resistance being there, is the fact that the Bollinger Bands turn flat. And so if the Bollinger Bands were still pointing up, if they're still flaring open, that's a good sign that they're anticipating a break of whatever level you're running into, in this case, resistance. And then we would continue with the trend higher. But instead, every time we get close and the Bollinger Bands do open up to allow the tick to go and test that level. But once we get into this range, they start to flatten back out, meaning that they're really not anticipating a break or move higher. And they think that there's a better probability that we will continue to hold that level. Now, of course, that can change with a bigger move. Perhaps if the debt ceiling finally gets resolved, which we know eventually will happen, right? That's always been the case. Then maybe that will be the catalyst for the market to try and break this level and bounce higher. But currently, we can see that we're not doing it, right? The Bollinger Bands remain flat, resistance continues to be respected. And so we have another reversal here. And what's kind of interesting about how the bar is shaping up for this week, it might change. Still a Wednesday early on, but this is almost a I know what Neil calls an equal opposite bar. Here at Simpler, I call it a mirror bar because if you were to put a mirror right in between these two bars, they almost look like a reflection of one another, right? We have the open here, we bounced up, had the close, we had the open of the next bar basically right by that close, and we're dropping down and currently, right, where we're trading at is right by the open of the prior bar. So usually when they match up like that, when they look like a mirror image of one another or an equal opposite bar, like Neil calls them, it can sometimes be a clue for a trend change, meaning that we have found a top here and we could start to see a stronger reversal. Of course, we do want to make sure that we're breaking support if we're trying to play this further to the downside, right? We're currently right around the 10 period simple. And this narrative, of course, might change because we have Fed minutes later today. We still have news later in the week that's coming out. We still have the debt ceiling looming over our heads in regards as trading with the market. And so all of those things we need to be mindful of. But if this is how it looks going into the close of the week, this could be a clue that we get a stronger reversal. Keep in mind from a bigger picture point of view for the year, as we've held 4,200, the bottom end of this range of choppiness has been 3,800. And we've seen that really last year going into this year. So I'm not saying we'll get all the way back down into that range. Certainly a possibility. But that would be another big level to keep in mind outside of the technicals and the psychological levels in between. Because if we do really start to reverse back down, the question will be, do we get down to 3,800? And if we do we hold it? And does that create a buying opportunity to then bounce back up and just play this overall 400-point range of chop that we've seen the majority of the year? Or do we actually start to break it and continue with the trend move lower? So, certainly things to keep in mind from a daily chart perspective. We've broken our simple moving averages as we've continued to stair step lower. Right now, we've worked our way into 4,100. That was the next big level to go into, which I'll show you here in a second as soon as the chart loads. There we go. So we tried to run up, hit 4,200 like we talked about, and even notice here on the daily chart, the Bollinger Bands, which we're trying to flare open, immediately have gone back into consolidation. So once again, just a clue that we might not be able to move higher. And then, of course, we've broken our 10 and 30 period simple from yesterday into today. And right now we're back around 4,100, which we know was price support back here whenever we were chopping in this 50-point range before the run up into 4,200. And of course, 4,100 is also a big psychological level. Anything that ends in those big zeros you always want to be mindful of. You usually see a lot of hedge funds and the big players, right? The big boys play around those psychological levels. So, oftentimes when the price gets near it, it's not uncommon, at the very least, for it to pause there for a second to see whether or not it's going to hold as, in this case, support, right? Or in the case of 4,200, resistance, before it can attempt to break and keep going. So 4,100 is definitely going to be a level to be mindful of short term. If we do manage to break it, though, then we have the move down here to the ATR trailing stop and the 100 period simple on a daily chart. And that's closer to 40.50. And you can see once again how that price level has held in the past. So currently, because we are in consolidation, one of the best ways to trade it is just trading from one level into the next. And if you start to stall at one level, like in this case, we stalled at 4,200, then look to potentially trade for the pullback move, right? If we start to break 4,100, then 40.50 is a good level then to play down into next. And if 40.50 holds or if 4,100 holds, then you could look to play the reversal back up into the prior level that we were at before we stalled. One of the clues, though, that you could have taken a bearish trade on this to the downside comes from our intraday chart. So let me actually make this a bit bigger for anyone on YouTube or Twitch so you guys can really see the intraday here. But it came specifically from the hourly chart. So for those of you not familiar with the divergent bar indicator, this is a beautiful indicator in my opinion. It is one of my favorite indicators to use while trading because it gives you a good probability of a higher high or lower low, depending on if it's a bullish or bearish divergent bar that prints. And it can make for some great overnight trades or some short term trades because usually, in my rule of thumb, I let the signal go for 3 bars. So within 3 bars, I'm looking at a good probability of either a higher high or in this case, a lower low. And what we found over in the mastery is that on specifically the hourly chart for SPX, if you have a divergent bar that prints that remains valid, certainly into the close of the day, like we saw yesterday, or that just didn't satisfy itself the day prior, there's a good probability that the next trading day will get the follow through. Now, once again, it doesn't always happen. So we always have to be mindful of our capital risk no matter what we do. But this allows usually for a really great overnight setup. And I'm kind of kicking myself because we walked through a trade idea in the master yesterday. And I was like, we're kind of a bit heavier on the bearish side in the account. So I'll hold off on it. But it was beautiful. Did anyone in the mastery take that setup? I'm just curious if maybe anyone else jumped into it. But I'll show you guys the trade idea that we were looking at. So we had a valid bearish divergent bar basically into the close. And so we were looking at yesterday the possibility of the 41.30, 41.25, because In regards to intraday trading, 4125 is kind of the next mini psychological level. It still keeps us above the 4100, which is that bigger level I mentioned that we could go down and test. And so if we did continue to roll over, which is what happened today, and we followed through at that lower low, there was a good probability this trade would work out. And it did. We looked at this trade, it was about $1.20 whenever we were looking at it yesterday into the close. And now you could see the mark is around 360. 350. So that's basically a 200% return on your risk if you had taken that trade for a quick overnight profit. So very nice to be able to do that. Certainly, if you are familiar with the profit recycling strategy, you could look to profit recycle the trade, and then you would have a fun bonus trade into the close today set at 41.25, which I don't think is a bad spot for a bonus trade, considering that one, we're kind of stalling here, right? 4100's attempting to hold. And two, if the market gets a positive reaction around the Fed minutes coming out later today, right, and it bounces up off of what is said in the minutes, then 4125 is right around these intraday resistance levels, and of course is a mini psychological level. So it could be a good place to have a bonus trade like that with no risk on going into the close. Um, Laura, I appreciate the update. I see that you mentioned about some talking heads, aka some Fed people probably about to talk here in a second. So that can, of course, always move the market. Hasn't been as dramatic as it was last year whenever they randomly got on the mic to talk, but always want to be privy to it. So I appreciate that. Nick is asking thoughts on KO. Wouldn't defense stocks kick in if the market top is in? So certainly we can take a look at KO. And as for defense stocks, that's a possibility. If there's a specific symbol that you're looking at from the defense side, let me know and we can pull it up together. But really, a lot of symbols that I have seen that were kind of in bullish trends that are topping out is in part because they were at weekly exhaustion. And so that's a really good clue that if you're really trying to play something bullish to the upside, take a look at the weekly chart and see where exhaustion is. Because if it's already had a beautiful run up and it's stalling, then there's a good chance that we could either just start to consolidate or we could start to see a stronger pullback. And in turn, right, might be a good reversal trade if there's a top coming in the market in general. Um, let's see. There is another question that came in from CJ. How is a divergent bar calculated? What is the main concept behind it based on range ATR? So I teach about this in my overnight profits class on how it's calculated. But in short, it basically is looking at the bars prior, and then it looks to see how that bar closes for the day. And depending on those calculations, it will either create a bullish divergent bar, which basically like buyers, right, jumped in, brought it back up, and that gives the good probability that within the next few bars you'll get a higher high. Whereas a bearish divergent bar, like here, for example, the sellers bring it back down into the close, and you see that it has a good probability of dropping within the next few bars. And of course, there's a bit more involved in that. And like I said, I teach about it in the class, but in short, that is basically what it's looking at. Is it looks at the prior bars that have printed as well as where that bar, the current bar, goes into the close of the day. Absolutely. And then Rush is asking, hey, Alice, I'm not sure if you already have said this or not, but was wondering if you still do the SPX Lotto Butterfly. So I do, Rush. And I'm happy to talk about that because we're on SPX now. So last year, right, the reason why those hit so well is one, we had first gotten introduced to everyday expiration. So for those of you who were trading prior to last year, y'all remember that it used to be back in the day. Sound old now. Way back in the day, it used to just be SPX monthly expirations. And then we finally got SPX weekly expirations where they're just on Fridays, right? Every Friday, which is what you see for a lot of symbols now, are those weekly expirations. And then from there, SPX decided to do Monday, Wednesday, Friday expirations. So we had it every few days. But then last year, they finally added Tuesday and Thursday expirations slowly. And they introduced that last year. So basically, you had now the possibility of 0-day trades every day the market's open. And so it took a second for the hedge funds to kind of catch up with that narrative. And it was funny because you could see it early on how they didn't quite get it at first. And then you start to all of a sudden see the volume and 0-day trading for SPX and the indexes like skyrocket. And it's because the hedge funds were catching on to the idea like, oh, with this volatility, right? It makes for some quick money to stick with the 0-day trades. And now that we have expiration every day of the week, right? There's that possibility to do it every day the market's open. And so what happened was with the volatility and with the introduction of that, it made for some really great runs into the close, which is how I typically look to trade 0-day expirations. But obviously, as we've seen going into this year, the volatility started to disappear, right? We can pull up the VIX now even and take a look at that. But the volatility started to decrease in the market. And we started to get into a lot more consolidation and chop. And so for 0-day end of day butterflies, right? Especially if you're letting them cash settle like I used to last year. Usually in more consolidation, see how the VIX has dropped down compared to last year, see how the bars are not as dramatic as they were last year, right? That's that volatility decreasing. Of course, today with the drop that we've had, it's getting a little bit of a spike up. But what happened basically is you wanted to look more typically at iron flies or iron condors. And the downside with that compared to the debit broken wing butterflies or the verticals that I used to trade quite a bit going into the close is they're a lot heavier on risk. And you also typically need to open them earlier in the day, right? And so usually and we've done a few iron flies and iron condors here in the profit recycling mastery. But what happens is one, you usually need to open it earlier in the day so you have at least a slightly better risk versus reward and you can get better premium on those options. But then two, usually with those strategies, I personally do like to use my day trade to jump out of them because, as we know, still going into the close of the day, you can sometimes get hit with that volatility because of the algos and because of the hedge funds to where it can spike the price going against you. And I personally don't like holding that much risk out there for doing those trades. So that's part of the reason I've cut back on those some is because the directional move into the close hasn't been hitting as much this year. And so from that risk narrative, and as you guys know, I really like to be mindful of my risk versus reward. I just haven't taken as many of them. If we do start to get a pickup in volatility again, then you will likely see me pull that tool, right, that strategy back out of my toolbox and start using it again because it's a better market environment for it. So that's why you haven't seen certainly as many in the challenge this year. And I haven't done quite as many. The other thing to note though is today might actually be a good day for it. I'm not anticipating it. But usually this year, right, when we have seen the more directional move into the close, it's come off of things like the Fed, right? So like the last Fed day where Powell actually spoke, right, earlier in May, it didn't cause a trending move in regards to the bigger picture on the daily chart for the market, but it did cause intraday volatility, right? We had a wider daily range than what we had saw previously, and it did allow for a great run into the close. And we saw that here, right? It literally closed at the low of the bar. And I'm still a little sad about this, but I had found a trade idea that I liked. I was trying to type out the alert. I should have just opened the trade and then typed the alert. But I was trying to be mindful, right? I usually like to have the alert prepped so that way when I enter the trade, I can immediately post the alert and you guys get it almost as soon as I get the fill, right? And so I was trying to prep the alert first. I chose the strikes, I was looking at everything. And then literally as soon as I finished typing the alert, it started to run on me and it started to get outside my risk tolerance. Now the trade worked out beautifully. So for those of you in the mastery who had jumped in early that day, because I know some of you guys will do that whenever we're looking at the trade idea together and y'all will front run me, right? And get in early before it moves. Y'all had a beautiful win that day. But for myself, by the time I actually went to go pull the trigger on it, unfortunately, the market had already started to move at that point, and it started to get outside my normal risk tolerance that I'd look for that trade idea. So we'll take a look again today, see if the Fed minutes cause a bit of volatility. And if it does, if it looks like we're going to get that trending move into the close, then I am all for looking at an end of day pin once again to take and see if it makes sense. But you got to remember, just like with any strategy, it all depends on if the market is giving you that trigger to then get into the trade and the entry. You don't want to force a strategy and you don't want to force a trade, because oftentimes when you do that, you're doing it based more off emotion. And that emotion, of course, can lead to losses in your account more often than not. And so that's why I haven't been doing those as much this year, just because the chart patterns haven't given me the trigger to usually jump into that trade idea. Certainly, I am on the mic every day into the close and the profit recycling masteries for those of you who are there interested. And I do still talk about levels and what I'd look at for an end of day pin, but I don't always take it myself just because it's not as clean of a setup as it was last year to really jump in and rinse and repeat that strategy. So when I do see one, like I said, if I see a good one today, I will certainly let y'all know, because I am looking for another challenge trade to jump into, and that might be a good one for today if we get the movement going. But let's talk about the Fed real quick, and then I'm happy to pull up KO for what Nick wants to look at. And of course, if you guys have any other questions around the market or any symbols that you want to look at, please let me know. I'm happy to pull them up as well. But today, right? Today is technically a Fed day. Now it's a little bit different than what we saw in May. Typically on Fed days, where Powell or whoever the head of the Fed is going to be on the mic and talking, and I see Tesla popped up. Absolutely. We can take a look at that one too in a second. Let me write it down on my list. So what typically happens on Fed days, whenever Powell, for example, is going to have the conference afterwards, when it's actually given to us that we're getting a rate hike or a rate cut or whatever they're doing, um, the chart pattern on an intraday perspective is usually pretty consistent. We move a little bit quickly at the start of the market and start to get in to whatever range that we're going to start chopping in going into the news. And usually on a normal market day, Europe closes at around 10:30 Central, so you'll get a little movement around that, and then we start to go into the lunch hour, and the lunch hour is typically where you see chop until the close of the day, the last couple hours, where you start to pick up a movement again. But on a Fed day, you typically will see that morning move rather quickly, and you'll start to go into consolidation a little bit earlier. It's not uncommon to get into consolidation prior to Europe's close, and you'll stay in that consolidation until 1 o'clock, when the news is first released on whether or not they're doing a rate hike or a rate cut, whatever their consensus is, right? That gets released at 1 p.m. Central. And when that gets released, you usually see a spike in volatility on the intraday move. And it usually happens both ways, where it will spike both up and down, right? It will be volatile. Those option premiums that were kind of built up prior to the announcement will start to go. And then it will pause for a second. Sometimes it stays volatile, but usually it pauses for a second until 1:30, because at 1:30, 30 minutes after the news is released, is when Powell and the talking heads of the Fed, right? They get on the they get on the mic and they start answering the questions from the press. And once they start answering those questions, the volatility kicks back in again. Still not uncommon to see it sometimes go in both directions, but usually as we get closer into the end of the conference, the market starts to choose a direction to go with. And like we've seen last year, usually it would be a bullish or bearish direction. It was very, you know, very trending on the move. On a more bullish market environment, when we've seen the Fed news, sometimes it would actually go back into the range that it was chopping in and stay there in that range going into the close. But we're still not quite in a bullish market environment yet. So usually we've still seen some sort of trending move this year whenever we've had those official announcements. The difference with what today is what's happening is that it's the Fed minutes. And so all this is, for those of you who don't know, is it's just a release of the notes that were taken in the prior session, right? So unfortunately, we don't have Pal, for those of us who like the volatility, right? We don't have Pal getting on the mic to answer any questions. There's no press conference that happens after the release of the minutes. It's just the minutes getting released. And so what typically can happen today is, once again, we usually identify a trending move quickly and then start to chop into the minutes. So that's what we're kind of starting to see here is we got the gap down, we ran lower, got close to 4100, that's holding us support. And then it tried a little bit for a bounce and a reversal here, didn't get very far. And as you can see, we're kind of right back in that range that we were in prior. So we're getting that consolidated move, that consolidation is allowing things like the technicals, like momentum, to get the reset it's looking for. And so we're kind of stalling. And so that's not uncommon still going into the release of the minutes. Once the minutes occur and those get released, you'll still sometimes get that spike in volatility in both directions, but it's usually not as dramatic as what we would have had like on May, what was it, like May 5th, whenever we had the last Fed meeting. So it's a little bit more muted on the volatility. And then sometimes it will still go on a trend move and start running again. But other times it will just kind of go back in that chop and remain flat, right? Because the thing about the minutes is they're just the notes from last time. So, given what happened at the press conference, most of the time we can already kind of know what the minutes are going to say, right? Because we've already had all these feds talking since the last one, anyways, giving their own 2 cents on what the market looks like and what they think should be happening. And so usually that's just reiterated within the minutes. Every now and then there's like a little surprise that pops up within the notes. But the second thing to be mindful of too is people have already seen the minutes. And what I mean by that is it's not like these magically get released and everybody's looking at it for the first time. A lot of the news companies like CNBC, they technically already have the minutes and they've already read it. And then that's how they have those articles already prepped. So that way, as soon as the minutes come out, you all of a sudden see all these news postings on, oh, this is what they said. It's because they've already been able to look over it and review it. And if they've already looked over it and reviewed it, not to get on conspiracy theory side, right? But more than likely, some of those big player hedge funds have also gotten a glimpse of what it looks like too. And so that's where you can sometimes still get the volatility and get the algos to start going. But because Powell isn't opening his mouth, right, to give us answers and to answer the press's questions, that's why it's a bit more muted because it goes back into what's known versus what is unknown in the market. The market doesn't quite know what Powell is actually going to say, right? To kind of cause it to go up and down. And that's where that volatility on normal Fed days, I'll call them, usually continues into the market close. Whereas today, because it's just the minutes release, we already got an idea of what's already known about it, right? We already got a sneak peek of that from the last conference, sneak peek of it from all the other talking heads that have talked since then going into today. And certainly the news organizations and things like that, they've already had a glimpse of what it is. So we might get a little bit of volatility. And I could be wrong. Maybe this time it will really be volatile and keep going. But usually it's a bit more muted because there's not going to be any sort of unknown conversation that occurs with a press conference. So, Craig, I know, surprise, surprise, right? They get the inside scoop before us. Not surprising at all. And happy to explain it, of course. And then, yes, so anything that's done in the $500 challenge specifically, I post over on Twitch. For anyone it's simpler, I post it in the free room. Of course, my Profit Recycling Mastery gets it first. Post it in the options room, but I do post the $500 challenge trades across the board. Otherwise, if it's just, something like in the options room or in the mastery, those are the only rooms that will end up getting it. But my $500 challenge, that I post across the board. So if I do end up taking a trade into the close today, just keep an eye on Twitter because usually I'll send out a quick tweet saying, hey, I'm jumping on, there's a trade. And I won't necessarily be on the mic, but you will see something like this, for example. You'll see my little notepad, and then you'll see my Thinkorswim account, which is where I do the $500 challenge, and it will show you exactly where I filled, what I have open, and it'll show you what the trade entry is there as well. So, that's basically what I'm anticipating for today. Is currently, I wouldn't be surprised if we chopped going into the news. We might get a little volatility around one once the minutes actually get released with those algos and things like that. But I still would be hard pressed to think that it's going to give us as much volatility as what we saw back here around the actual Fed announcement. And keep in mind, even the last Fed news, we got the intraday volatility, but in regards to what it did compared to what we've seen last year, it's not the strong trending move that would follow, right? Last year, whenever Fed minutes got released, we got strong follow throughs on an actual trend move, either up or down. But this year, even with all the rate hikes still and everything else, the narrative has been a bit more muted. We've been a lot more in chop more often than not. We've had little runs here and there, but the majority of the time we've been stuck in consolidated ranges. So that's, until that breaks, that narrative changes. That's why I mentioned at the start of the session, just look to play from one level into another. And if it starts to break, then you go into the next level. If the level that you're at currently holds, then look for a potential reversal back the opposite direction. And Nihan, this wasn't a trade. This is a really old trade, right? It's way past April. But this is what I'll typically show over on Twitch on my screen share. And for those of you at Simpler, this is basically a trade alert that I'll post in the alert section if it's a trade I'm taking. But don't take that trade because obviously it's May. So you wouldn't be able to find it on the option chain either way. That's an older trade from the challenge that I have saved. So let's pull up KO and then we'll take a look at Tesla. So over here on Coca-Cola, you can see here this has also kind of been hitting a price resistance level up at the top. So we ran up into it recently. We hit price resistance and now we're starting to fall back down. And this is why, for those of you who don't know, this is why I literally have a post-it. Here's my post-it for those of you who see me on camera. I literally have a post-it saying, beware of price support and price resistance because of exactly this reason. You could see this setup, right? You could see the bullish trend. You could see the squeeze building up, the Bollinger Bands becoming narrow, how it's attempting to hold support and think, oh my gosh, this is going to take off to the upside. But if you're at a price support or price resistance level, you need to be very cautious about the possibility that it is not going to break that range. I have seen too many times where all the indicators, right? Even here, the indicators were in agreement. But I've seen before where momentum's building up. We have bullish signals here. We have a squeeze. Bollinger Bands even look like they're starting to open up. Everything looking like it would break to the upside, but you're at a price resistance and price resistance wins over everything and it drops back down. And that's kind of what happened with Coca-Cola here. I'm sure if we pull it up on a weekly chart, it's a bit more clear on that price resistance I'm talking about. But we basically ran into that on the recent run up. It held, right? We didn't break above it. And so now we're getting that reversal. And yeah, you can see it pretty clearly here. So what is that price? That is what, 64, 65, right in that price level there. We were hitting it as a price resistance. And once again, right, and even down here, there's that more bullish aspect with momentum, with the compound breakout tool, the squeeze. All of that would lead you to believe, oh, we're going to break higher. But notice the Bollinger Band started to flatten out. We started to stall. And now we're getting that reversal back down. And on a weekly chart, we're going right back into the 100 as support. So I don't know how much lower I would necessarily trade this because the 100 has done a pretty good job of holding support in the past. If we do break a little bit lower, past the 100 period simple, which is at $60 right now, the ATR trailing stop is at 59.08. So that would kind of be the next target. If we start to break these levels, uh, and of course, if the Bollinger Bands start to open lower, then we might actually continue in a bearish trend. On the daily chart, we're already starting to break below the 100. So it's trying to find that weakness to pull it back down into 60 as soon as it loads up here. And there is certainly room on momentum from a daily perspective for this to keep going, right? We just had a cross below the zero line, and there is plenty of room for that to continue lower until it hits the bottom of the axis. You have the Bollinger Bands flaring open. One of your clues, actually, that this could keep moving lower came in the form of third deviation Bollinger Band snaps. So I know that we've talked about this, I think, in here before. I've certainly mentioned it in my room sessions in the past. But when the underlying price starts to break the third deviation Bollinger Band, even if it does something like this where it makes a bullish divergent bar, there is a very good probability that the underlying price will either one, stay within this bar's current range, right? And kind of just hang out there. Or two, it will actually continue to move in that direction. So in this case, this happened on the lower Bollinger Band. So we know that there's a possibility it could actually continue to move lower. And I think of it as a case of FOMO, basically, on the reason why this happens. Anybody who wanted to be short in this and sees it has a case of that fear of missing out. And so they pile in. And then on the flip side, of course, anyone who is long and starts to see this move happen is like, oh my gosh, my trade's getting ripped apart. I need to get out of this. And so they close out of their bullish bias. And both of those components can keep leading the price lower. And so in this case, we had a third deviation Bollinger Band snap the next day, made a slight lower low, another third deviation Bollinger Band snap. The following day, notice how it, for the most part, stayed within that trading range, but it also made that bearish divergent bar. So a bearish divergent bar as things are turning bearish, better probability of that follow through. Excellent follow through, of course. Here you can see within the 3-bar rule, aka the next bar, it got that strong lower low. But notice what happened on this next bar, third deviation Bollinger Band snap. So what did we see? We saw a continuation lower here, and then we're still moving lower today. Now, as of right now, today, this hasn't exceeded the third deviation Bollinger Band, and it's had a nice run lower. Not to say it can't keep going, but if you were short on this from back up here off of these signals, I would definitely consider protecting profits if you haven't already, because we are starting to get to a point where, of course, we're getting closer to $60 as the weekly support. And this has already been a great run. The underlying price typically doesn't like to stay outside the comfort zone, which is the second deviation Bollinger Band. So normally, right, when we zoom back out here, you can see that the price usually trades within the second deviation Bollinger Band. That's the comfort zone. So we know at some point, one of two things is going to happen. Either the price is going to bounce back up to get back inside the second deviation Bollinger Band, or it's going to stall and allow the Bollinger Bands and the other technicals to then catch up with the price to get it back inside that range. So the momentum certainly has the possibility to keep this going lower, and the squeeze is just starting to fire. So that might give it a little bit more room. But I'd be mindful about 60 because of where that 100 period simple is on the weekly chart acting as support. And then right below it, I think I said at like 58 or something was that ATR trailing stop. I'd be mindful of those two levels. If it looks like we're starting to stall at all in that range and you left like a runner on, feel free to just protect your remaining profits and take them off the table. As for a new trade idea, it's really not a spot for me to jump into a new trade idea. Sometimes when you make a third deviation Bollinger Band snap like this and you still have a valid squeeze, sometimes I'll get into like a smaller risk tolerance trade and still play it because I know between the squeeze, the room on momentum, and that third deviation Bollinger Band, it can keep the price going. But at this point, the only thing you really have working in your favor is the room on momentum. The squeeze has already started to fire. We're already getting close into our next support level on the weekly chart. And so it's just not the best opportune place to really jump into a trade idea here. So if you took it, well done. If you didn't, that's okay, right? There's always going to be another trade setup that we can look for and take advantage of. So no need to force a trade. Let's go on to Tesla here for our next one. And Nick, absolutely not a problem. And then Amazon. Yeah, we should have enough time for Amazon. I'll pull that, add that to our list here and pull it up in a second. So on Tesla, as we zoom in here, uh, Tesla. So the issue I've personally had with Tesla this year is it's been battling the $200 price level. And so for those of you who don't know, let me actually zoom back out. $200, which is right in this range, has been a really big price level for Tesla the past couple of years. For a while, like back here, you can see it acted as a price support level. Every time we got close and tested it, it would hold as support and we bounced back off of it. Then going into the end of last year, when Elon started selling some of his shares in order to buy Twitter, we saw the break of 200. And that once we started to break below 200 and would bounce back up to test it, it started to act as price resistance, right? So price support, once it's broken, turns into price resistance. And so we tried to test it here, failed, tried to test it here again, failed, and then we really sold off. And that was a bit of fun, right? We traded that to the downside. And then, right, we stalled. We had a run up into earnings. Anything on the first quarter of last year earnings that had any sort of slight bounce into the announcement and they met their target, right? They didn't just completely disappoint on earnings. A lot of these symbols would have very nice gaps to the upside and continuation higher. And Tesla's no stranger to that. It had a bullish divergent bar prior to the announcement, certainly gapped up and followed through with that higher high, ran higher. And then we started to get back into that 200 price level and we kept attempting to break above it. But you can see that every time we tried to break higher, we never actually got a trend going. It would basically stall, reverse back down. Then we tried again here. That was a failure. And then we start to go into a bit more of a attempting, I should say, a bearish trend. It was still more consolidating trend. But we broke the 100 on the last earnings from a disappointment, right? The market was disappointed with what earnings said. And so we tried to move a little bit lower, stalled, and now we're running back up. But notice yesterday the price got close to 200 and then gave us that bearish divergent bar. Today we followed through with a lower low. We're still holding support, but you can see it's just been kind of like a hot mess, if you will. It can't quite get going to break above 200, but it also hasn't completely fallen apart into a stronger bearish trend to try and play lower. It's just been a very, very choppy chart. And so for myself, I've played it a couple times this year, certainly not as much as I've probably played it in the past. And that's due to this consolidation in this price level. So really what I keep watching overall from a bigger, kind of trending point of view here on Tesla is can it actually break and hold above 200 and get going into a trend? Or does it keep failing in this level? And if it does, and if the market starts to turn and Tesla decides to follow along, then do we get a stronger reversal back down like we've seen here to give us an opportunity to maybe short? And so even on our lower indicators, you can see momentum's attempting to cross above the zero line. That's a bit more bullish. Down here, though, on the compound breakout tool, this is still very much a consolidating signal. The short-term squeeze that we had attempted to fire to the upside, but like I said, it basically stalled just shy of 200. So for those of you who like to trade Tesla, please, please, please be mindful of that $200 price level. That's going to be a huge level to see whether or not we can actually break higher and continue to the upside, or if it just keeps holding as that price resistance and we stall and reverse back down. So at this time, If we close with a bullish divergent bar today into the close, like we're forming right now, you might do a quick reversal trade for a bounce back up, because, a bullish divergent bar printing off support with bullish momentum gives it that probability of getting a higher high compared to today's bar within the next few trading days. But I probably wouldn't try and play it past 200 by any means. I would probably look for a quick scalp trade just to play it back up into the highs here around 190, or probably a better idea, given the back-to-back divergent bars, given the Bollinger Bands are already starting to look like they're flattening out, giving the convergence signals on the moving averages and the compound breakout tool, you might actually lean towards an unbalanced put butterfly. And that was actually something we talked about yesterday in the free trading room. Unbalanced butterflies are a great way, when they're credit unbalanced butterflies, to not necessarily have to be directional about a move to still lock in a profit. So let's see, these moving averages are right around 176, 175. So I don't know if we'll get enough premium on it for this week, but the idea would be to look at something like this. Yeah, to me, this isn't enough premium to take this trade idea. But let's say we got like a 50-cent credit, right? Or maybe you push this out a week. The idea is we're not going to break support, right? That support is going to hold here at 175 at that psychological level. And so we take a 50-cent credit with an unbalanced butterfly. As long as this remains out of the money, if we follow through with a higher high and try and run up towards 200, this trade would expire worthless, and the credit that we received here would be our locked in profit. If, however, we're wrong, right, and it pulls back into support, doesn't break it, but it pulls back to test it, the beautiful thing about unbalanced butterflies versus just doing a straight credit spread at this level is it actually really gives you a very nice max profit potential of $300, $3. It's the 50-cent credit that you receive here plus the 250 with spread. And so if you pull back but still hold your short strike, in this case 175, your butterfly portion of this trade almost acts like insurance, and it still allows you a really great profit. The risk, of course, is if you start to break support. So if these moving averages can't hold, if Tesla does really start to break back below the 100, then you have to be okay with the risk on this trade, which is currently $200, right? $2. The 2.5 width of the spread minus the credit you receive of 50 cents, which is how you get 2. So like I said, currently the mark on this is like 15 cents for this week's expiration. I personally would want a bit better of a credit to make, a bit more sense on taking this trade. Arguably, if you have a larger account, you could just bump up the quantity of contracts if you wanted to have that make a little bit more sense. Just keep in mind you're also increasing your risk around the trade as well if you take that action. But if we close in a bullish divergent bar today, that would probably be strategy wise what I would lean towards, because that way it fits a bit more with the consolidating components that we see on the chart, like the back-to-back divergent bars usually mean overall chop, the flattening Bollinger Bands, the compound breakout tool, but it still gives us that slight added bullish sentiment with the rising momentum, with the fact that we're holding support with the lows for the day, of these moving averages, and that we are technically, as of right now, making that bullish divergent bar. So that's what I see for Tesla. Otherwise, though, like I said, the big level to watch for those of you really trading it one way or another is 200. That's kind of the battle line for Tesla. It needs to really break above that if it wants to continue in a bullish trend. And if it can't, we, one, might be stuck in chop like we have been this year, or two, if we really start to break down, could lead us into a stronger pullback into last year's lows. And then let me pull up Amazon here really quickly. And then Dr. Bob, I think I'll have time to look at CRM. Let me write that on the list. I think we should. Market's already giving it back up from that bounce up. So we're retesting 4,100 again. Not surprising. So Amazon here, Amazon had a really great run to the upside recently, right after its earnings, it had a little bit of a pullback into support. Support held. Notice the bullish divergent bars, right? So typically on this indicator, because we've just been talking about it a bit today, I usually look for bullish divergent bars and bullish trends, right? Because they're not counter trend signals. So they have a better probability of following through. Whereas I'll look for bearish divergent bars and more bearish trends because once again, it's not a counter trend signal. That being said, that was a really good entry. That was a good re-entry. As of right now, though, still a bullish trend. We're right back at the 10 period simple, so that looks good, holding as support. However, momentum, right? Not quite at the top of the axis, but it's getting close. And we're starting to see a red bar today. So this could be a clue that we might be starting to see some exhaustion and need to be a little bit more mindful of how much more of a run to the upside this is going to get. On the compound breakout tool, we do have one red box printing. Now, because the trend is still bullish when this signal started to print, it is still down here a valid bullish trend signal, but you want to be careful and watch out because if you get two or all three lines to print a red box, or if you start to get choppy on the signals, right, like back to back bullish and bearish signals, then it cancels out the bullish trend signal that's currently printing, and we either start to print a pullback signal or a consolidating signal. Really quickly, let's look at the weekly chart, make sure we're not running into weekly exhaustion because that could be another clue that this run higher could start to, at the very least, pause, if not maybe get a little bit stronger of a pullback. Wait for this to load up. There we go. So momentum on the weekly chart just recently crossed above the zero line, still has plenty of room to the upside. So for anyone who's bullish, that actually benefits you. We do still have a weekly squeeze, so that could help keep it going higher. On the weekly chart, we're not near support, so it's not really the best entry. A better entry would have been last week whenever we started to break above the ATR trailing stop to continue this higher. But in regards to a target to the upside, the 100 period simple is at 132. So that might make a good overall target for a run higher if you're playing a swing longer term. But from a daily chart perspective, I would probably just be mindful of the capital risk I put into it, only because we're starting to get that red momentum bar, and that can sometimes lead to exhaustion. Everything else about this still looks actually pretty bullish, right? Bollinger Bands are still pointed up. We're doing a good job of holding the 10. We still have a bullish signal here. But once again, this has already had a bit of a decent run. So if you're looking to buy in here, just be mindful that if we get back up to the recent highs around 118-ish and it starts to stall, you take the quick win, right? And then, of course, if we can break higher, then keep going with the trend, certainly. Because of how Amazon is priced now, it certainly wouldn't be out of the question to maybe go out a couple weeks, right? You could go to like the June monthly expiration, for example, if it's within your risk tolerance, and either look to jump into a long call at 120, right? That's just a little bit below the 118 target here. So if we bounce up and start to stall, given the time on the trade, should allow for a quick win. Or, of course, if that's a little bit rich for your risk tolerance, if you're trading a smaller account, you could also look at a spread, right? The 117, 120 strikes are about $1.29, gives you a lot of room to still play to the upside. It's still a 171 profit potential, so it creates a good risk versus reward scenario. And you don't necessarily need a huge move up in Amazon just for the trend to continue, for this to start to go on the money and work in your favor. I will say there's quite a bit of open interest here around the 120 levels on both sides, on the put and call side. So might get a bit of stalling there with how much open interest there is. So it seems like a good target, right? Short-term target to try and play higher. But that's what I'd see for Amazon. I don't know personally if I'd want to take a trade in that myself, especially if the market does start to reverse, unless Amazon's going to act like a honey badger and just continue higher and do it at once. It is a pretty big component of the market. So if the market does start to break 4,100, and get a stronger reversal, we could either see Amazon at the very least pause or maybe get a stronger pullback. And if it does get a stronger pullback, let's say down into the 30 and to the ATR trailing stop and it holds, much better place to then buy in and try and go long versus up here on a move that's already seen a decent run to the upside so far. And then last but not least, let's pull up CRM here. And then Dr. Bob, you're thinking of a broken wing butterfly for next week. Life in my days, absolutely not a problem. So let me pull it up on the option chain too. One thing to remember, guys, about next week is it is a holiday week for the market, meaning we do have a market holiday on Monday. And typically, when we have a market holiday, it's not uncommon for the market to kind of chop going into the holiday as well as coming out of the market holiday. That because that's usually like when the hedge funds and the big boys, right, will take their vacation days around the market holiday and kind of extend that long weekend. So volume typically kind of drops off some, both going into the holiday. So, in the next couple days, if the volume gets lighter, don't be surprised about it, as well as coming out of the holiday. I think the only way I could see maybe volume staying a bit more spiked this current holiday, market holiday, is with the debt ceiling, right? With those talks, that might keep traders a little bit more in their chairs to see if they make it by the June 1st, quote unquote, cut date, if you will. Um, but outside of that, typically going into market holidays and coming out of them, you'll get that lighter. So usually things like credit spreads or iron flies, iron condors, things that benefit from theta decay might be a better route to go just because if all we're kind of doing is chopping, if we're not really getting those big moves off of the market, that theta decay going through the market holiday, right? Because you have an extra day of theta decay without the market working against you, can sometimes be the better strategy to go with. So keep that in mind. Now, for CRM here specifically, the first thing I note is we have earnings. So, Dr. Bob, personally, there's no trade I'd be doing on this for next week's expiration outside of maybe an earnings lotto trade. And the reason why is unless you're doing, like, let's say, for example, this prints in a bullish divergent bar and you're looking for a quick overnight trade going into the end of the week, right? Maybe you'll get the bounce of a higher high follow through and be able to scalp a quick win. But outside of that, what we've seen a lot this year going into the earnings announcement is if it's already had the run up, which this arguably has, usually we start to chop into the news. And so, one, right, chop, that leads into the idea of doing that consolidated trade idea, right? So that would kind of benefit it. The downside, though, is on something like CRM, you're not going to get the theta decay that you would in Amazon, for example, or in Tesla, because Amazon and Tesla have already had their earnings, right? We've already moved past it. CRM still has earnings ahead of it prior to next week's expiration. So, what typically happens on the option side of things is the option premiums stay spiked, or they actually continue to increase in value going into the announcement. And then you won't see that premium and that theta decay really creep out of the options until the announcement occurs, right? And then from there, you might get a spike if it's a volatile move, might be a non-event where it stays flat. It doesn't really matter. That's when the option premiums will readjust themselves to where the out of the money strikes start to lose value again. And if you're in the money, right, you'll have potentially a nice profit. But until that news event occurs, which is on the 31st aftermarket, so at the end of the month here, more than likely what we will see is consolidation. And you're already getting clues of that with the Bollinger Bands turning flat, with some exhaustion here on the momentum side of things, with the red bar, with the choppy signal and the compound breakout tool. All of that is cluing you in that we could likely just start to sit here going into that news event. So if you want to take an earnings lotto trade, then the one that you mentioned here, that broken wing butterfly, might be not, that might be a good idea. But what I would say to do is if you're playing off the idea of a volatile move, one, of course, be 100% okay losing this capital because it's a lotto trade, right? Anything you hold short term through earnings, You got to be okay losing in case it goes against you. But two, I would also consider putting on something on the put side. I'd play both ways, and I'd play off the strong probability that we will get a volatile move like we saw in last earnings. But because you don't know of the direction the market's going to react in, right? Is the market going to react positively to give it a gap up? Or will it react negatively to drop it down? Because of that uncertainty, I would look to set up something on both sides. So play something bullish to the upside, but also set something up on the put side. So that way, if it's like this, like the earnings from last year, and it's a negative reaction, then you have something up to give you that profit on the other way as well. Aaron, you're headed to the Hamptons. We'll have a beautiful vacation. I'm sure that's going to be lovely up there by the beach and stuff. But that is my time today, guys. So thank you so much for joining me. I hope today was educational. I think it was. We talked about the Fed and Fed minutes, the difference in that. We talked a little bit about the market holiday, went over the levels in the market. So thank you guys so much for joining me. If I do see a good end of day pin later today that I can set up for the challenge account, or if I just see a different challenge trade that I like, I will certainly alert it out and let y'all know. But otherwise, may the trade be with you, my fellow Jedis, and I look forward to talking to y'all.